webinar. Today we'll be looking at a new topic, ICT Trading Strategy. Hi, welcome everyone. Then in the meantime, if you cannot hear me or see me, please let me know. Okay, and without further ado, we shall start our webinar. And before we start, please note that everything in this video is educational in nature. Nothing should be constructed as investment or trading advice. Remember to do your own due diligence before you guys trade. And also please note that trading Forex and CFD carries a high risk of high level of risk to your capital. As you trade with money you can afford to lose. And remember to do your own due diligence before you guys trade. So now let's go to today's webinar. And today we'll be looking at ICT. Okay, and here is the agenda for today. Firstly, we'll look at what is ICT Trading Strategy. Okay, and the key ICT concepts. And also understanding ICT trading strategy and what smart money looks like in price action. Okay, so this is the first of this is a two-part series and is the first of the two-part series. And the next one will be conducted by Peggy. Okay, and I'm your host, your presenter for today. I'm Emily from EFG Group. So EFG Group, we are a finalist for Best FX Research and also Best Equity Research in the year 2020 and 2021. So this webinar is brought to you in collaboration, okay, with IC Markets together with EFG Group. So if you have any question in the meantime, feel free to leave it in the comment section. Okay, so let's start with the introduction. Okay, so what is ICT? Okay, if you heard the term ICT trading, is pretty popular on the online trading community, especially for Forex trading. So ICT, also known as inner circle trading, okay, it was created by Michael Hudson to trade the Forex market. But now traders are using the same strategy to make profit in all and any market they trade. Okay, so Michael Hudson, who has over 20 years of experience in trading the markets, he created this strategy and has grown to become one of the most popular trading strategies around. Okay, this is fully focusing instead solely on price action. Okay, then what is ICT trading strategy? Okay, so today we'll be doing a lot more on the fundamentals, the basics, what is ICT trading, and also the different trading methods. Okay, but for a start, we'll be looking at what is ICT trading strategy. Okay, so this is a methodology that employ chart technical analysis and operate under the premise that by studying price movement, support and resistance level, and also order blocks, okay, one can to some extent pinpoint the area with the high liquidity concentration and consequently forecast emerging trends. Okay, so this is actually used for forecasting trends. The ICT trading methodologies and strategies were very much the first of the kind in the online retail trading space. So previously, they were more or less just technical price action traders, fundamental traders, and also traders trying to leverage supply and demand. However, the ICT methodology managed to capture all of these elements cohesively and it also essentially rely on finding great prices, okay, using institutional footprints within the markets to follow what Michael believes the market movers are doing. So these strategies are executed at certain time of the trading session, okay, to ensure trading volume is high enough to move price swiftly. So, and also there is a Q zone in the trading session where ICT traders like to place their trades. So the method utilized are in essence supply and demand within the markets, but in a much more intelligent way than the retail industry has ever seen before. Okay, and this all sounds great in principle. We have seen traders claim to be able to do this and read institutional order time and time again. Okay, but ICT is the first group of traders that seem to be able to back up their claims. Okay, so even though the strategies are still subjective, which can make it harder to find probability, however, there are enough rules and methodologies for traders to build a fairly robust rule-based system from this down. Okay, so we'll be looking at some of the rules and concepts that we'll be following, and that is also important for ICT trading. Okay, and here are the concepts of ICT tradings. Okay, it consists of some key concepts that every trader must know in order to take advantage of this trading style. Okay, so we have a few here. First is liquidity. Okay, like previously mentioned, it's also used to forecast liquidity and displacement, market structure shift, inducement, fair market gap, optimal trade entry, balance price range, and also order block. Okay, first up, we'll be looking at liquidity. Okay, so there are two types of liquidity, buy side and sell side, and also the other one is just solely the sell side liquidity. Okay, so this is where short sellers will have their stops position. Sell side liquidity is just the opposite. Okay, and also liquidity is the first and the most important concept within the ICT trading. Okay, so there are two types, like once again we mentioned, buy side and sell side. Okay, that's number one. So buy side liquidity represent the level on the chart where short sellers will have their stops position. Okay, and sell side liquidity is just the opposite. It represents the level on the chart where long buyers trader, okay, will place their stops. So in both cases, these levels are often found at or near extremes at the top and bottom of ranges. Okay, and these are often viewed as area where traders are proven wrong and therefore want to go out of their trade. Okay, so let me do a recap. Because liquidity is the first and also the most important concept within the ICT trading methodology. Okay, and there are two types of liquidity. First, okay, we have the buy side and sell side. Okay, so buy side liquidity represents the level on the chart where short sellers will have their stops position. Sell side liquidity represents the level on the chart where long bias trader will place their stops. So in both cases, okay, so in both cases, these levels are often found at their near extremes, okay, at the top and also bottom of the range, okay, because these are the range where often viewed as area where traders are proven wrong and therefore want to go after trade. Okay, so next is displacement. So displacement, in short, is a powerful move in price action resulting in strong selling or buying pressure. So generally speaking, displacement will appear as a single or a group of candles, okay, that are all positioned in the same direction. And these candles typically have large real bodies and very short wicks, suggesting very little disagreement between buyers and sellers. Okay, so you'll be looking for candles with very large bodies and very short wicks. Okay, so this will be displacement. And the next concept is a market structure shift. Okay, as many traders know, the basic of trend say that in an uptrend, the price is making high highs and also high lows. And in a downtrend, the price is making lower highs and lower lows. So a market structure shift is represented by level on the chart where the previous trend is broken. Okay, so if the price is in uptrend, the market structure shift is where a lower low is made. Okay, so this is where market structure has changed. So if the price is in a downtrend, okay, market structure shift is generally going to be at a point where a higher high is made. Okay, so in both cases, market structure shift tends to occur on the heels of displacement. Okay, so once price has traded through a market structure shift level, a trader will begin to look for further signs that trend has in fact changed, using the market structure shift as a level to trade off. Okay, so this is just capturing the uptrend and the downtrend. Okay. Okay, and the next concept will be inducement. Okay, so inducement, because rarely does the price move in a straight line. So within a large trend, there are almost always counter trend move, and these counter trend moves are the result of a lower time frame liquidity hunting. Okay, so the price will bounce or get rejected, and then will target a previous short-term high or low before continuing in the same direction as the longer-term trend. So inducement is specifically the targeting of these short-term highs and lows as area where stops might be placed. So rarely does the price move in a straight line. Okay, so within a larger trend, there are almost always counter trend move. So this, like I previously mentioned, the counter trend move are the results of a longer time frame liquidity hunting. So the price will bounce, okay, rejected, and then will target a previous short-term high or low before continuing in the same direction as the longer term trend. So inducement is specifically the targeting of these short-term highs or lows as area where stops might be placed. Okay, if you'd like me to go slower, please let me know. Okay, and because this is a fairly new concept, so later we will go through the ICT concepts again. Okay. The next one is actually a fair value gap. Okay. So for fair value gap, these are created within displacements and are defined as instances in which there are inefficiencies or imbalances in the market. And these imbalances are visualized on the chart, okay, by a three candle sequence containing one large middle candle whose bordering candles upper and lower wick do not overlap. Okay, so okay, see if I can try to draw it. Okay, so it's categorized by a three candle sequence where a large candle is in the middle. okay, was bordering candles, upper and lower candle wicks, okay. So the one before, okay, okay, do not overlap. So it will look something like this. Okay, so after the price reaches a liquidity level and then reverse, what will come after next is displacements. Okay, so liquidity level and then reverse, and then what comes next is displacement. Fair value gaps are created within these displacements. Okay, and are defined as instances in which there are inefficiencies or imbalances in the market. Okay, so the fair value gap is created within the displacement. Okay, these imbalances are visualized on the chart. Okay, like this 3 candle sequence. Okay, so after the fair value gap, we'll look at optimal trade entries. Okay, just that they represent the best place to get into a trade, and they can be identified by utilizing the Fibonacci join tool. Okay, so in most cases, the optimal trade entry will lie somewhere between 61.8 and 78.6 retracement, okay, of an extension range. After market structure shift occurs and a new leg of price action is formed, okay, the bounce that follows the new leg of the yield and opportunity to take a position in the direction of a new leg. Okay, and these Fibonacci retracement levels can be used to identify where the position should be taken. Okay, so you can use the Fibonacci to identify a level, okay, on where you could enter the trade. And what's left after these instances is essentially a double fair value gap. Okay. Oh, sorry. Okay, now we are looking at the balance price range or imbalance. Okay, so a balanced price range is a result of an aggressive move up that is immediately followed by an aggressive move down. On an aggressive move down, there's immediately followed by an aggressive move up. Okay, so let me repeat. A balanced price range is a result of an aggressive move up that's immediately followed by an aggressive move down. Or, okay, in the second scenario, it's an aggressive move down that is immediately followed by an aggressive move up. Okay, so it's up or down. Okay, what's left after either of these instances is essentially a double fair value gap, okay, which can act as a magnet to the price before a continuation move higher or lower. Okay, so after the aggressive move, okay, there is a double fair value gap which acts as a magnet to the price before a continuation move higher or lower. So balanced price ranges can sometimes signal the beginning of a market structure shift, and price can often retest and also reject from this area. Okay, and what smart money looks like in price action. So SMC trading involves looking at a order block, which is a refined version of supply and demand. Okay, a breaker block, a mitigation block, flip zones, FEG, and liquidity gaps. Okay, these terms replace support and resistance level, reversals, and also volumes. Okay, so the key components of SMC. Okay, and here are some of the key parts of the smart money market theory. Order block, okay, is simply a replacement for the supply or demand and asset experience. Breaker or mitigation blocks, this is what traditionally called support and resistance. Okay, fair value gaps, okay, which we mentioned earlier, are imbalances on the market when demand outpaces supply or vice versa. Okay, so these are the terms that SNC trading will involve. So if you are into this trading, you could see these terms really often. Okay, so we are down to our last slide. Okay, and I will go through a recap. Okay, and thereafter, if we have some time, we can take a look at the chart for some key level of support and resistance. Okay. So, like I mentioned earlier, today's session is mainly to introduce you to ICT trading, what is the strategy about, and the concepts of ICT trading. Excuse me, sorry. Okay. So ICT, also known as inner circle trading, okay, is focusing solely on price action. Okay, so this method, this trading strategy is used for price action strategy, where you identify the key move made by market makers. Okay, and ICT methodology and strategies were very much of their kind in the online trading space. Okay, and this methodology employs chart technical analysis and operates under the premise that by studying price movements, support and resistance level, and order blocks, one can to some extent pinpoint the areas of the highest liquidity concentration and also forecast emerging trends. Okay, so that's why liquidity is a very important concept in ICT trading. Okay, so these strategies are executed at certain times of the trading session to ensure trading volume is high enough to move price swiftly. So there is a Q zone in the trading session where ICT traders like to place their trades. Okay, the methods utilize which is supply and demand within the markets. Okay, and here are the concepts. Like one of the most important concepts will be liquidity. Okay, and we also have displacement, market structure shift, inducement, fair value gap, optimal trade entry, balance range, and also order block. Okay, sorry. Okay, so back to recapping the liquidity. Okay, is where there are two types of liquidity. Okay, and buy side and sell side. So buy side liquidity represents the level on the chart. Okay, where short sellers have their stocks position. Sell side liquidity is just the opposite. Okay, represents the level on the chart where long bias trader will place their stops. Okay, and so in both cases, these levels are often found their near extreme, as the tops and bottoms of ranges are often viewed as areas where traders are proven wrong and therefore want to go out of their trade. So we will be looking for this range. Okay, So after liquidity, it will move to displacement. So after liquidity happen, there will be displacement. So in short, displacement is a very powerful move in price action, okay, resulting in strong selling or buying pressure. So displacement will appear as a single or a group of candles. Okay, they are positioned in the same direction. Okay, and these candles have very large bodies and very short wicks. Okay, so suggesting very little disagreement between buyers and sellers. So I'm sure that most of you have seen candles like this, right? Like the very big bodies. Oh, sorry about the ugly drawing. Okay, very big bodies, and you have this tiny little wick here. Okay, so we'll be looking for candles like this, a single or group of candles. They are all in the same direction. Okay, so suggesting very little disagreement between buyers and also sellers. Okay, market structure shift, which is a change of trend. So in short, okay, is represented by a level on the chart where the previous trend is broken. So if the price is in an uptrend, market structure shift is where a lower low is made. So if a price is in downtrend, this is where price where a higher high is made. Okay, so in both cases, the market structure shift tend to occur on the heels of a displacement. So once the price has traded enough, okay, traded through a market structure shift, a trader will start to look for further signs that the trend has in fact changed. Okay, using the market structure shift as a level to trade off. Okay, so we will use this as to look for signs of trend reversal. Okay, and next up will be inducement. Okay, because price rarely move in a straight line. So within a larger trend, there are always a counter trend move. So these counter trend moves are the result of a lower time frame liquidity hunting. So the price will bounce or get rejected, and then we'll target a previous short-term high or low, okay, before continuing the same direction as the longer trend. So inducement is specifically targeting of these short-term highs or lows, okay, as area where stops might be placed. And next we'll be looking for fair value gap. So fair value gap happens after, okay, so first up we have liquidity. So after a price reaches a liquidity level, okay, and it reverses, it often what often comes next is displacement. Okay, so fair value gaps are created within these displacements, okay, and are defined as instances in which these inefficiencies or imbalances in the market. So these imbalances are visualized on the chart, okay, like what you've seen here. And the lower and upper wick do not overlap. Okay, so we are looking for displacements. Remember, will be this big body with small wick. Okay, so within displacements, you could see candles like this. Okay, and the optimal trade entry, which is also the best place to get into a trade, and it can be identified by using the Fibonacci. Okay, so the best level is actually 61.8 and 78.6. Okay, so after a market shift occurs and a new leg of price action is formed, the bounce that follows the new leg will often yield an opportunity to take a position in direction of a new leg, and these Fibonacci retracement levels can be used to identify where that position should be taken. Okay, and we use these two levels to identify. And then we have a the balance price range, or also known as imbalance. Okay, this is a result of an aggressive move up that's immediately followed by an aggressive move down. Okay, aggressive move up followed by a move down, and also a move down followed by a move up. Okay, and what's left after this happened is either of these instances is essentially a double fair value gap. Okay, which acts as a magnet to the price before continuation to move higher or lower. So what you want to look for is after the balance price range that happens. So it will be somewhere around here, somewhere around here. Okay, before the continuation of trend. So this also can signal the beginning of a market structure shift, and price can often retest and rejects from this area. Okay, and these are the terms on SMC trading, which involve looking at order block, a refined version of supply and demand, breaker block, vegetation block, flip zones, FEG, and also liquidity gaps. Okay, and breaker on mitigation blocks is actually traditionally what we call support and resistance. Okay, so order block is simply replacement for supply or demand, and fair value gaps is demand is it's actually the imbalance on the market where demand outpaces supply or vice versa. Okay, we are done with today's session. We are done with today's ICT trading strategy. Okay, so I hope that you're able to absorb, or I mean, help you have a better understanding on the fundamentals or this ICT trading strategy. Okay, before we go for more in-depth part 2 session. Okay, and now we'll be looking at some indices. Okay, so let's take a look at the dollar index. So you can see that this is the H4 chart for dollar index. Okay, and the dollar index, you can actually see that it's on a downtrend. Okay, so there is actually a channel that is trading downwards. Okay, so it touches 3 weeks here, 3 candles. So okay, so you can see that dollar index is on a downtrend for now, and even though on the H4 chart is above the Ichimoku club, but looks like it is still going down. Okay, and okay. So key support level will be here. Okay, a nice multi-swing low. Okay, and this pullback here can be the first resistance. Okay, so it's in between the price, in between the first support and first resistance level. Okay, but it looks like it's going up or heading to our first resistance level. Okay, and this can be our second level of resistance. Okay, and this pullback support will be our second support level. Okay, so looks like the price has bounced off and is heading toward the first resistance level. Okay. Okay, let's see if there's any news that is impacting today's dollar. Okay. So today is the 9th. Okay, so there's no news that is actually impacting the dollar. Okay, and also not any is there any major news yesterday? Okay, so okay, but the dollar is dollar index slightly doing better. Okay, and next up we'll take a look at gold. Okay, so I'm sure that many people are into trading gold. Gold is currently quite bearish below the Ichimoku cloud. Looks like it's bearish for now. You could draw. Okay, oh nice. The 61% Fibonacci retracement level is right. Aligned nicely with the first support. So this first support acts as a pretty strong support level. Okay, good enough for the price to bounce up to a resistance level, which I think we can use this as our resistance. Okay, looks like it's heading towards our first resistance. And the price still looks like it's on a downtrend. Look for projection. Okay, and since price has bounced off, the projected level of the price could go up is here to 0.89, which also can be our second resistance level. Okay, but before it could be it could rise up to the second resistance. Okay, there's actually a first resistance level here, and actually I think it's also close to the 50 Fibonacci retracement level. Here it's not. We could draw Okay, so it is close to the 50% Fibonacci retracement area. Okay, so this could be quite a strong resistance for gold. So they do have a strong support and strong resistance, so price could fluctuate in between the first support and first resistance for a while. Okay, we also can look at be looking at oil, as even though the news on like the high supply, okay, oil prices still quite steady. It's because of the Saudi Arabia agreed to cut their oil supply. So despite US supply is higher, you can see that the oil prices is actually high for this week. And we do have a first support level here. And the second one is also pretty straightforward with this pullback. Okay, and this will be too close, so this will be my first level resistance, and followed by the swing high here. Okay. And the 78.6 Fibonacci retracement is still valid. Okay, it hasn't been broken through, so we could use the 78% Fibonacci retracement. That is aligning closely with our first support. Okay, so this will be for WTI oil. And take a look at Bitcoin. Okay, so for Bitcoin, it's very bullish, but it's coming down. You can see that the price has reversed off the all-time high here. Okay, it looks pretty similar to what happened at the beginning of the year. Okay, so it's reversing off. This will be my first resistance, followed by support level, which is here. This is the second support level. Okay, it's about, okay. And good. See if I can find any extension. Okay, nice. There's a 127 extension. Okay, that's aligning with the first resistance, and I will also use the 161 extension for the second resistance, because in lack of a better resistance level, so I'll be using this. Okay, and there is also a support for the 38.2 aligning with the first support level. Okay, and 78.6 aligning with the second support. Okay, so it makes the first support level a pretty strong level of support. And we have Bitcoin. So we're all looking at the H4 chart. Sorry, it is Ethereum. Okay. This multi-swing low will be our support. It's slightly far, so I guess I need to see if I can. Okay, I can find something that is nearer, closer to our current price. I'm just gonna use this for my first support, and this will be the second. Okay, our resistance is here. And the second resistance is this multi-swing high. We could also draw retracement. So the 78.6 retracement is still valid and it aligns with the first resistance. Okay, hence making it a strong level of resistance. Okay, where you can see that price has reversed off. Okay, and I think we can also take a look at some indices. So, okay, DJ30. Okay, first level of support. It's not a good one, so I guess the second level will be this. Okay, this will be my second support. Slightly far out if I could. Okay, no, that's not really valid. Okay, this will be my second level of support. And resistance is also pretty straightforward for the first one. Okay, it's right here. Could extend it all the way here to this candle. Okay, our second can be the wick here. Okay, the 61.8 has been broken, so I'm not gonna use this for my for any Fibonacci. Likewise for yeah, I do find the second support is a bit far, but there is a lack of a better support. So that's the only one that I could place. Okay, it'll be somewhere around here. So DJ is also bullish. Okay, moving up to it's actually in the Ishimoku cloud, but looks like price is reversing off. Okay, breaking the resistance level here. Okay, it has broken the resistance level and is like moving down towards the first support. Okay, so this will be all for today ICT trading strategy session. Okay, this is the part 1 of a 2-part series, and thank you everyone for joining today's session, and thank you for your participation, and I hope that you'll join us on our second ICT I hope you join us on our second ICT session. Okay, so thank you everyone for tuning in, and have a great week ahead. Stay safe and trade safe. Thank you everyone, and I see you guys in the next IC Markets webinar. Bye.